Trump's sudden move into tens of millions in bonds is the kind of financial signal professionals don't ignore, not because of the amount, but because of the timing. Markets don't react to headlines nearly as much as they react to behavior, and when a sitting U.S. president shifts this aggressively into fixed income, seasoned analysts read it as a clear message. Someone with direct visibility into policy, regulation, and federal strategy is positioning early for conditions that haven't fully surfaced in public data yet. The disclosures confirm the scale. Between late August and early October 2025, Trump purchased at least $82 million in corporate and municipal bonds. The upper range of the filings places the potential total as high as $337 million. Federal ethics statements don't list exact amounts, only ranges, but the pattern is unmistakable. It wasn't one large purchase. It was a rapid series of transactions across issuers, sectors, maturities, and states. That kind of allocation is rarely random. It usually reflects conviction. Professionals who have spent decades watching capital flows understand why this matters. Bond buying is not like buying stocks. Stocks are speculation. Bonds are signals. Large bond allocations almost always express a view about interest rates, credit conditions, liquidity tightening, or upcoming policy actions. When corporate executives buy bonds, analysts pay attention. When hedge funds buy bonds, economists pay attention. When a president buys them, entire markets take note, because the decision carries a shadow of additional information. Information tied to regulatory posture, federal spending timing, geopolitical assessments, and macroeconomic risks. A close look at the issuers strengthens the point. Trump purchased bonds from Intel, Qualcomm, Broadcom, Meta, JP Morgan, Goldman Sachs, Morgan Stanley, Bank of America, and several other major corporate names. These companies are connected to sectors that depend on federal direction: semiconductor expansion, AI infrastructure, banking regulation, capital requirements, and technology oversight. He also purchased municipal bonds from school districts, counties, development authorities, transportation networks, and utilities. Municipal credit strength is tied directly to federal budget decisions, interest rate trajectories, and tax revenue stability. Taken together, the purchases form a profile consistent with someone positioning for a specific view of the coming environment. A senior fixed income analyst would interpret the shift one of three ways. The first possibility is that Trump expects interest rates to stabilize or decline. When rates fall, bond prices rise. Investors who anticipate rate cuts often accumulate bonds before the move, particularly if volatility in financial markets is rising or inflation appears to be cooling. The second interpretation is that he expects spreads to tighten, meaning strong companies and municipalities will become more creditworthy. That would make their debt appreciate in value. The third possibility is that he sees elevated uncertainty in equity markets and is hedging toward assets with more predictable returns. None of these interpretations are dramatic. They're practical, and that is exactly what makes the pattern meaningful. Most investors buy bonds for one of two reasons: to preserve capital or to exploit interest rate expectations. A president buying bonds does not have the same constraints as retail investors. He doesn't need passive yield. He doesn't need portfolio balance. He buys because he sees risk or opportunity in the credit markets. And when someone with policy influence chooses credit over equities, it suggests they expect the next phase of the market cycle to reward certainty rather than speculation. The specific corporate issuers tell a story of their own. Intel stands out immediately. Just months before the bond purchases, the U.S. government announced new involvement and investment commitments into semiconductor manufacturing. Intel bonds, already considered investment grade, benefit from this due to strengthened balance sheets, increased government support, and long-term demand for chips. A professional looking at Trump's Intel allocation would describe it as aligning with a well-supported credit trajectory. The same applies to Broadcom and Qualcomm. Both companies sit at the center of telecommunications infrastructure, AI processing, and national security-sensitive manufacturing. Their debt is not high risk. It is tied to sectors receiving federal incentives, supply chain reshoring focus, and long-term investment. Buying their bonds is a vote of confidence in the stability of those industries, not a gamble. Then there are the banks. JP Morgan, Goldman Sachs, Morgan Stanley, and Bank of America are not obscure issuers. They are the backbone of S. Credit markets. Their debt performance is tied to the health of the economy, regulation, liquidity, and capital rules. A heavy allocation to bank bonds signals a view that these institutions will remain strong, liquid, and profitable in the policy environment ahead. Bond buyers generally avoid financials during recessionary fear. Buying bank debt suggests an expectation of resilience. Municipal bonds add another layer. Municipal credit strengthens when tax revenues stabilize and federal support increases. Infrastructure spending, which Trump has advocated throughout his public remarks, benefits municipal balance sheets. Buying muni bonds across multiple states signals confidence that municipalities will remain solvent and well-supported. Municipal bonds typically benefit from falling interest rates. Lower yields mean their existing higher coupons become more attractive. A large purchase of munis suggests expectations that rates will not rise dramatically from here and may eventually trend downward. In professional terms, it appears to be a quality tilt allocation, moving into stable issuers, long-term sectors, and federally influenced credit. It is not speculative, and it is not random. Now consider the timing again. The purchases occurred during a period when inflation had begun to cool, but interest rate expectations were uncertain. Markets were debating whether the Federal Reserve would hold rates, cut them, or raise them slightly due to persistent service sector inflation. Bond markets were showing mixed signals. Equity markets were still strong but volatile. In those environments, experienced investors reposition before clarity arrives, not after. They look at forward guidance, fiscal plans, international conditions, and credit spread behavior. They move before the public sees the trend. The bond market is often described as the smart money market because it reacts to fundamentals instead of emotion. Equity markets follow narratives. Bond markets follow math. When a significant participant enters the bond market aggressively, other professionals interpret the move as a sign of impending adjustments, particularly to interest rates. If the president buys bonds, the implication is not that he controls the Fed, but that he has insight into fiscal tightening, fiscal expansion, borrowing costs, federal funding cycles, and geopolitical risk that influence rate trajectories. The effects on ordinary people come next. Bond yields directly influence mortgage rates, auto loans, business credit lines, and even credit card interest. If yields fall because demand increases, borrowing becomes cheaper. If yields rise because other investors step back while a major actor steps in, volatility increases. Either outcome affects households. And even if Trump's actions do not directly change yields, they shape expectations. Expectations shape markets. Markets shape the cost of borrowing. The chain is simple and unavoidable. One detail analysts noted is the diversification across maturities and regions. Trump did not concentrate his municipal purchases in a single state or category. He spread them. This suggests confidence in broad municipal stability rather than localized strength. Broad stability is typically associated with predictable federal funding, economic steadiness, and a manageable interest rate environment. It is not the kind of allocation made by someone expecting a municipal debt crisis. There is also the regulatory angle. Corporate bonds from banks benefit when regulatory pressure eases. If banking regulation becomes more favorable, credit outlooks improve, and their bond prices rise. Buying bank bonds before regulatory adjustments is a strategic choice. It reflects awareness that certain rules may shift. Professionals also pay attention to conflict of interest risk. Even though the White House stated these investments are managed by a third party, markets don't rely on assurances, they rely on incentives. The risk is not that policy is being manipulated for personal gain. The risk is that perception of such possibilities increases uncertainty in certain sectors. Perception alone affects credit spreads. Finally, there is the historical pattern. Policymakers tend to reposition portfolios before large economic shifts, not after. This applies to administrations, treasuries, central banks, and executives. When a major decision-maker rotates into bonds, it typically reflects a view that yield opportunities are improving, growth risks are rising, or volatility is expected to increase. Trump's actions do not guarantee a recession, a rate cut, or market instability. But they do suggest he expects the next phase of the economic cycle to reward bondholders more than equity chasers. And that expectation, coming from someone with direct insight into fiscal direction, is too significant for professionals to ignore. Trump's bond accumulation didn't happen in a vacuum. To understand what it signals, professionals look at the broader environment. Interest rate pressure, credit market tightening, U.S. fiscal conditions, global capital flows, and the structural challenges inside sectors where he purchased the most debt. Because when someone in his position allocates tens of millions into bonds, the key is not the amount or the issuer. It's the timing relative to the macro cycle. And the truth is, the timing aligns with one of the most uncertain transitions in modern U.S. monetary history. At the moment these purchases were made, the Federal Reserve was caught between two competing pressures. Inflation moderation had started, but not consistently. Borrowing costs were historically high, but policymakers were hesitant to cut too quickly. Bond markets were sending mixed signals. Long-term yields rose sharply, then cooled, then rose again, reflecting confusion among institutional investors about the path ahead. Credit conditions tightened for businesses, consumer delinquencies ticked upward, and municipal budgets were facing stress from years of elevated prices. Against this backdrop, Trump's sudden tilt toward fixed income stands out as a deliberate move toward stability. A finance expert analyzing this would begin with rate expectations. Bonds purchased in late 2025 would perform well if interest rates decline or even stabilize after a volatile period. Experienced allocators know that interest rate cycles don't turn overnight. They shift gradually, guided by a combination of inflation data, employment reports, global capital flows, and government borrowing. Someone connected to federal fiscal plans would naturally have a better sense of timing around Treasury issuance schedules and budget direction, two variables that heavily influence long-term yields. This context gives weight to Trump's decision to enter the bond market with such size. The corporate issuers he chose provide further insight. When investors buy Intel, Qualcomm, Broadcom, or Meta bonds, they not chasing yield. They signaling confidence in credit stability for sectors at the center of U.S. industrial policy. The semiconductor industry remains under heavy government support because of national security concerns and supply chain priorities. Corporate bonds issued by companies benefiting from this support typically behave predictably. They maintain strong ratings, consistent coupon payments, and a lower probability of default. Buying debt tied to American chipmakers suggests an expectation that these companies will remain insulated from macroeconomic turbulence. The same logic applies to banks. J.P. Morgan, Goldman Sachs, Morgan Stanley, and Bank of America all operate under regulatory environments that can shift in response to administrative priorities. A president allocating capital toward their bonds could be interpreted as anticipating stable earnings, manageable credit risk, and regulatory flexibility. When banks are expected to maintain strong capital positions, their bonds become safer and more attractive. This also signals a belief that refinancings, lending activity, and deposit stability will remain relatively healthy. For someone with professional insight into policy direction, bank bonds can function as a quiet expression of confidence in the resilience of the financial system. Municipal bonds add an entirely different dimension to the story. Muni markets reflect the financial strength of local governments, school districts, transportation networks, and infrastructure authorities. Their creditworthiness is shaped by property tax revenue, sales tax collections, federal support, and state-level fiscal management. When a president buys muni bonds across multiple states, he's signaling that he expects municipalities to weather existing pressures without severe deterioration. That expectation rests on several assumptions: stable tax receipts, effective budget management, and potential federal backing for infrastructure improvements. This aligns with a broader view that public sector credit may strengthen rather than weaken in the coming years. Professionals also consider the psychological impact of high-profile bond purchases. Even without intent, a move like this influences perception. Investors may view it as a signal that yields have peaked or are close to peaking. If enough market participants interpret it that way, demand for bonds could rise, pushing prices up and yields down, reinforcing the original expectation. In the bond market, perception often becomes reality because traders watch each other as closely as they watch economic data. In addition, many experienced analysts believe that Trump's allocation reflects a risk-adjusted view of equity valuations. By late 2025, equity markets had rallied significantly, while corporate earnings began to decelerate. Profit margins were under pressure from higher labor costs, sticky inflation in services, and elevated borrowing expenses. When equity valuations expand faster than earnings, downside risk increases. Moving into bonds during such a period can look like the classic professional rotation, stepping out of overextended equities into stable fixed income before a potential correction. A second factor professionals evaluate is liquidity. Bond markets offer stability, but not all bonds offer equal liquidity. High-grade corporates and widely issued munis have consistent trading volumes. Trump's portfolio avoided thinly traded or high-yield bonds, which would have added unnecessary risk. Instead, he focused on issuers with predictable liquidity profiles. Bond allocations of this scale require confidence in the ability to exit positions if market conditions deteriorate. This reinforces the view that the purchases were intentional and informed, not experimental. Another perspective relates to fiscal conditions. U.S. government borrowing projected for the next decade is exceptionally high, with deficits expected to exceed $1.5 trillion annually. Heavy issuance of treasuries often puts upward pressure on yields. When treasury yields rise, corporate and municipal issuers must offer competitive yields to attract buyers. A professional anticipating elevated government borrowing might enter the bond market early, before higher quality issuers adjust spreads or before liquidity becomes strained. Trump's move into bonds during a period of rising treasury yields aligns with this behavior. One of the most important elements in understanding this decision comes from how bonds respond to geopolitical pressure. Semiconductor companies, global banks, and municipal governments are often directly influenced by international tensions. In recent years, supply chain risks, sanctions, cybersecurity threats, and global capital reallocation have created opportunities for stable issuers. A president seeing these dynamics firsthand might conclude that long-term credit from certain strategic sectors offers more reliability than equities exposed to geopolitical shocks. The bond market also reflects expectations about credit quality. When a professional anticipates improved financial performance or steady government support, corporate and municipal bonds become attractive. For example, munis tied to transportation or utilities may strengthen if infrastructure spending increases. Corporate bonds from tech or semiconductor firms may benefit from consistent government contracts or tax incentives. The diversity of Trump's bond purchases suggests a belief that multiple credit segments will remain stable, not just one. This runs counter to recession fears and aligns more with a soft landing mentality, a scenario where the economy cools but avoids collapse. Another factor analysts consider is the maturity structure of the bonds. While federal disclosures do not list precise maturities, the pattern of issuers chosen implies a mix of intermediate-term and longer-term bonds. Intermediate maturities benefit when rate cuts begin. Longer maturities benefit when rate cuts accelerate or inflation falls sustainably. A professional expecting rates to plateau or decline would favor maturities that capture price appreciation as yields adjust downward. The absence of short-term, high-yield, or speculative issuers reinforces the interpretation that stability, not tactical yield, was the goal. High-experience observers also understand the optics. A president buying stocks could create immediate conflicts with market-moving announcements. Bonds, however, are less sensitive to single policy decisions and more influenced by macroeconomic trends. Buying bonds offers the ability to position quietly without raising the same level of ethical concerns as equities. This makes bonds the logical choice for someone seeking to allocate capital while minimizing perceived conflicts. For everyday Americans, the consequences extend beyond political implications. Bond yields influence mortgage rates, car loans, business credit, student loan refinancing, and the cost of government debt. A major shift toward bonds by influential investors could contribute to shifts in yield expectations. If yields trend downward, borrowing becomes cheaper for households. If yields remain elevated but stable, it signals inflation control without economic collapse. Either way, the direction matters for families planning major purchases, retirees relying on income, and businesses evaluating expansion. The final interpretation professionals make is about market positioning rather than political commentary. Influential investors, policymakers, institutional managers, and seasoned allocators frequently adjust their portfolios before downturns or before improvement. Trump's move is consistent with someone expecting a transition, not a crisis, not a boom, but a shift. Bond markets are often the earliest indicators of such transitions. When experienced individuals move into fixed income, the message is simple. The next phase of the cycle will likely reward credit over speculation. And this is exactly why professionals don't ignore what Trump did. The value of the move is not in the amount. It is in the signal, the belief that the next environment will favor bondholders. And signals from people with access to fiscal and regulatory direction are often more reliable than public speeches or forecasts. The most important question professionals ask when they look at a move like Trump's bond accumulation is the one the public rarely considers. What does this reveal about the underlying direction of the economy? Not the surface-level narratives, not the headlines, but the deeper structural forces shaping credit demand, liquidity, borrowing costs, and financial stability. Because the bond market isn't where people gamble, it's where they prepare. And Trump preparing through fixed income, at this size, tells analysts that the next phase of the U.S. economic cycle will revolve around discipline, debt management, and credit behavior rather than pure equity speculation. To understand this, it's necessary to examine the pressures facing the U.S. economy at the same time these bonds were purchased. Government borrowing was approaching extraordinary levels. Treasury issuance was heavy. Long-term yields were volatile. Municipal budgets were adjusting to multi-year inflation. Corporate debt rollover schedules were tightening. Banks were navigating a complex regulatory period. And households were contending with historically high borrowing costs. In this kind of environment, seasoned investors start shifting attention from growth narratives to balance sheet realities. They become more interested in who can service debt reliably, not who can tell the best growth story. This broader backdrop is essential to interpreting Trump's decisions. A move into corporate and municipal bonds during this period suggests a belief that credit conditions will remain manageable, not easy, but stable enough to reward patient holders of high-quality fixed income. And stability, in times of transition, becomes a far more valuable asset than rapid returns. When markets strain under uncertainty, investors who position early into credit often outperform those who chase the final moments of an equity rally. Another angle professionals look at is the concept of informational asymmetry, not in the illegal sense, but in the structural sense. A sitting president has visibility into fiscal policy trajectories, infrastructure planning, agency priorities, regulatory frameworks, geopolitical orientations, and technology investment strategies long before the public sees them in data releases or official forecasts. This visibility influences how an experienced policymaker interprets macro conditions. If that interpretation points toward yield opportunities or improved credit quality, moving capital into bonds becomes a rational, informed, and expectation-driven decision. This interpretation aligns with how the strongest fixed-income investors behave. Bond markets reward those who anticipate shifts in liquidity and rate cycles, not those who wait for confirmation. When someone like Trump shifts into bonds aggressively, it shows belief that forward rate expectations, credit spreads, or long-term fiscal conditions will make fixed income increasingly attractive. For an ordinary investor, the move might appear slow or technical. For a professional, it's a quiet but clear signal about where strength may emerge. The selection of issuers reinforces this. By prioritizing investment-grade corporate issuers in strategically important sectors, semiconductors, telecommunications, AI infrastructure, and global banking, Trump's portfolio shows an assumption that these companies will remain stable through both macro uncertainty and policy transitions. Experienced investors who have lived through multiple cycles understand that sectors tied to national security, global payments, and critical infrastructure are rarely allowed to deteriorate materially. These companies often receive implicit or explicit government support, favorable regulatory adjustments, or direct investment incentives. Buying their bonds is a way to anchor capital in institutions unlikely to face sudden credit shocks. The municipal allocations reveal a similar thought process. Municipal debt only attracts large, smart allocators when they believe tax bases will hold, budgets will stabilize, and state-level credit pressure will not escalate. That requires confidence in employment stability, consumer spending, and long-run federal backing. A president allocating to multiple muni issuers reflects an expectation that municipalities will remain solvent, and that the fiscal environment will not deteriorate dramatically. For a professional reading this signal, the message is straightforward. Broad municipal credit remains intact, even if national macro conditions fluctuate. Another detail that stands out is the diversification across issuers. Trump didn't concentrate on one region, one sector, or one maturity range. He spread his allocations broadly. This kind of diversification is common among institutional investors who believe credit risk is manageable across the board but want to avoid concentration risk in any one subsector. It again reinforces the view that this was not a short-term yield grab, but a long-term positioning decision based on expectations of macro stability. Professionals also examine what was not purchased. There were no high-yield bonds, no distressed issuers, no speculative credits, no emerging market debt, no unusual structures, no risky municipal categories. Every issuer chosen appears on the conservative, investment-grade side of the spectrum. This tells seasoned analysts that the motivation was not risk-taking, not opportunistic speculation, but the pursuit of dependable income streams in stable entities. It aligns with a portfolio approach designed to weather fluctuations in Fed policy and credit cycles. The next layer of interpretation relates to inflation behavior. By late 2025, inflation had cooled materially from its peak, but remained unstable in specific sectors. Professionals know that fixed income performs well when inflation expectations decline, because real yields become more attractive. A large move into bonds suggests belief that inflation will gradually normalize rather than reaccelerate. Policymakers often have early visibility into supply chain adjustments, energy planning, regulatory changes affecting costs, and federal procurement patterns. If those internal signals pointed to stable inflation, allocating capital to longer-term bonds would be consistent with expected price deceleration. Then there is the impact of refinancing cycles. Corporations and municipalities alike faced significant refinancing obligations in the years ahead. Investors who believe credit markets will remain healthy during these refinancing cycles often seek exposure to issuers who can comfortably manage their obligations. Purchasing their bonds is a form of confidence that refinancing will occur smoothly rather than with stress. It also indicates a belief that overall borrowing costs may ease over time. For the average American, none of this appears obvious. People feel the economy through different touchpoints: mortgage rates, credit card bills, auto loans, rent increases, and employment conditions. They don't see the signals the bond market sees. They don't monitor corporate refinancing schedules or municipal revenue projections. They don't track the complex relationship between Treasury issuance and yield curves. But they experience the consequences. When someone with influence buys bonds aggressively, it may foreshadow changes in borrowing conditions that trickle down into everyday life. If bond prices rise and yields fall, mortgages become more affordable. If yields stay stable while inflation cools, consumer purchasing power improves. If institutions remain creditworthy, market panic is avoided. A finance professional also considers international dynamics. Bond markets don't exist in isolation. They react to foreign capital flows, geopolitical tensions, trade policies, and currency behavior. Trump's bond purchases occurred during a period when foreign demand for U.S. debt was shifting. Some countries reduced holdings, others increased. Global investors were evaluating U.S. debt sustainability, interest rate direction, and geopolitical risk. By entering the bond market aggressively, Trump aligned himself with a view that U.S. credit remains fundamentally strong despite noise. This view matters because U.S. Treasuries anchor the global financial system. A belief in credit strength reflects a belief in system stability. Another element experts pay attention to is leadership behavior. Historically, policymakers acting before major moves, whether rate cuts, fiscal adjustments, or regulatory shifts, position their financial exposure accordingly. This doesn't imply wrongdoing. It reflects how professionals behave when they understand economic conditions from the inside out. Leaders observe liquidity patterns, federal budget pressures, global alliances, and risk signals earlier than the public. Their portfolio adjustments quietly communicate expectations. In professional circles, Trump's bond allocation suggests long-term confidence in credit markets and a cautious outlook for equities. It reflects a belief that interest rates are near a turning point, that inflation will be contained, and that strategic sectors will remain stable. It also reflects caution, a tilt towards certainty in an uncertain period. This combination is common among seasoned investors who anticipate economic transitions rather than reacting to them. In the end, the significance of these bond purchases is not political. It is structural. The fixed income market is where informed investors prepare for the next phase of the economy. Equities tell stories. Bonds tell the truth. Trump chose bonds, and professionals interpret that choice as a signal that the next chapter in the U.S. economy will be shaped not by speculation, but by credit behavior, yield adjustments, and balance sheet strength. For households, businesses, financial institutions, and state governments, this shift matters. A president positioning into bonds is effectively indicating that the environment ahead will reward stability, disciplined balance sheets, and predictable income. It means interest rates may be approaching a plateau. It means credit markets may remain resilient. It means strategic industries will maintain strong fundamentals. And it means those paying attention to fixed income will see opportunities before they surface in the equity market. This is why professionals watch moves like this closely. Not for the controversy, not for the headlines, but for the signal. And this signal is clear. The next phase of the cycle will favor those who understand credit.